All right, everybody, welcome back to Off the Grid on the Record, the podcast where we dive into the minds of people actually building the clean energy economy, not just dreaming about it. Today's episode is a deep dive into commercial solar, project finance, and quietly powerful force in the Australian market behind the meter renewables. I'm joined today by Shane Bartel, the CEO of Climate Capital, a dual role development and investment firm managing a $200 million plus pipeline of solar and storage assets across Australia. Shane and his team don't just build solar farms, they design, fund, own, and operate them through a unique vehicle called CCREAT, which we'll get into. Whether it's reshaping what renewable investment looks like at the sub 5 megawatt scale, we'll get into it all. So Shane, welcome to the show. How you doing today?
Great. Thank you very much.
Of course. No, we're happy to have you here. And if you're okay with it, I'd love to jump right in. I mean, you've had an unconventional path into renewables, from the world of tech into leading a clean energy investment and development firm. What drew you into this space?
I think I've probably been in the sustainability space for quite a while. I started off at Sir Sanford Fleming, actually, just up the road from you, doing environmental sciences, and just kept on working my way into it. But I quickly realized when I got over here as a backpacker that I could do a bit more, and found myself looking at wind farm development in 2001. And I went down that path because it was a real emerging market for Australia. I enjoy the private equity side as opposed to, say, government or government-owned entities. And I just got into it with some mates down here and learned a lot about the market. It was, and it still is, a relatively small market here, or as in network. I can usually pick a few names from every conference that I've worked with at some point in the past, when they were a graduate and now they're a senior something something. So it's maybe showing my age a bit, but it's been over 20 years in the industry here. Jumped into solar about 7 years ago because wind farms, look, they take too long. I want to do more in the time I've got. So ended up seeing the trends, identifying that going big is not always going better. I'm saying that with quite a bit of experience of multi-hundred megawatt wind farms and a couple solar farms that we've looked at as well too. But identifying that a team of 4 or 5 could do quite a bit of good, and we jumped in. So we're lucky enough. We got the right investors on board initially. They're impact investors, family offices, and they basically set us on our path forward. They said, hey, sub 5 meg is about the right check size for us. If you can pull off 1 or 2 of those a year, that'd be great. But here's the mission statement. It's decarbonize the grid and support Australian businesses. And so now every project that we look at needs to fall within that.
That's fantastic. I love that. And I mean, I kind of want to get more into that side of things, but for listeners maybe unfamiliar with the Australian market or, I guess the specific subsector, give us the Climate Capital overview. What do you build? Or who do you serve? How do I pronounce it? CCREAT, create?
Yeah, just create is fine. Yeah. That
How
was
do create and Climate Capital work together?
That was about 6 minutes of us turning our chairs around to face each other. So what should we call it? So CREATE is the acronym for Climate Capital Renewable Energy Assets Trust. So it's a trust, and that trust holds a number of SPVs or special purpose vehicles, and every SPV is one project. So all the assets go into that SPV. That's wholly owned by CREATE. And it's a good structure for investing for a lot of our investors up until recently, in particular for tax reasons, but also just for flexibility for the future. So I guess the question around, how do we get to where we are, where the model sits? Climate Capital is a developer, and we identify projects, design projects to meet a certain investment criteria for CREATE, who is our asset holder. So we've got DevCo and AssetCo, and CREATE is really just made up of the same shareholders of Climate Capital. They just want all of their assets in one unit trust, so that at some point, probably in the near future, they can sell on to a larger capital firm, and we can build more at a greater pace. So we're lucky enough to have about 30 million right now in operating assets over across 4 projects. But using that motto or that mission statement that I mentioned before, we identify industrial participants. So we've got a mining company in Western Australia, an abattoir in New South Wales, which is the state that Sydney's in. Mm-hmm. We've got crypto mining in South Australia, and we've also got a soon-to-be disclosed behind-the-meter customer in northern Tasmania as well too. And those are our 4 operating assets. They make up almost 15 megawatts in the ground. The
Wow.
sub 5 megawatt area, because of our national electricity market, or NEM, which operates mostly on the eastern side of Australia where most of the population is, they've got certain rules, and we can talk about constraints if you want for quite a while. But one of their rules is that anything 5 megawatts or greater is classified as a semi-scheduled generator. So if you apply for sub 5 megawatts to export onto the grid, you're a non-scheduled, and your modeling prior to getting an export license is slightly easier.
Hmm.
Not a lot, but slightly easier, a little more predictable. So a lot of our projects will be sub 5, or the DC component might be higher, might be 6, 7, 8, 9 megawatts DC, but our inverter, where all the DC goes into and then AC comes out, will be 4.95. And so that's kind of set the
Hmm.
scene for the sub 5s within Australia. So you can build a sub 5 and you can put it straight onto the grid, or you can build a sub 5 behind an abattoir, provide to them, and the excess or the spill generation can go onto the grid as long as it doesn't
Hmm.
exceed 4.95 or whatever your magic number is. So that's the approach that we've taken. The reason we've taken that is because a lot of these businesses are, I would say, small to medium-sized C&I, commercial industrial. I'm not sure your audience, how well versed they would be in some of the terminology, but if they are consuming 5 gigawatts per annum, so 5,000 megawatts per annum, that would be kind of around the size that we start looking at, and maybe up to
Hmm.
20 or 30 megawatts or something like that, or gigawatts per annum. What that means is that we can put a sub 5 megawatt, and it could be 2 megawatts, 3, 4, 5, something like that, which ranges from about 4 to 8 million Aussie dollars in the ground. We could put that
Hmm.
in, and they could offset their grid requirements by anything from 20 up to, say, 60%. And there's a magic number in there. Once you get closer to 100%, the value of a per kilowatt supply goes up quite high. Batteries are helping to pull that down now because the battery prices are coming down. But if you go straight solar
Hmm.
and you're going behind the meter, the majority of your electricity should offset a lot of their daytime requirements. And if it's sized properly, then it's the best value for both parties. So that's what we really targeted. Which industries require it? Because they usually can't negotiate really good offtake agreements with retailers because of the size that they're at. And I can get a bit more into what core business is for us versus others, but that's usually where we
Hmm.
come in at. So hence the variety of industries that I just mentioned that we already service, and many more coming.
That's fantastic. I want to get into that specific idea also because, like you mentioned, you've brought several projects online already. You've got Tregalana, Juni, Bell
Junie?
Bay, each with different Juni, each with like a different profile and each with like a different, I guess, makeup. What have these builds not only taught you about the Australian solar market, but how have they been different that kind of fed into the entire business?
Yeah, great question. I can go to a number of different points on that. I think um, explaining how we approach it would help. When we make friends with some of these counterparties, we really are there for the long term. Our approach to this, we're not a contractor or a consultant, we're an asset owner. So we're also doing our DD on them as well as them doing theirs on us. We'll approach them or they'll approach us, and we'll work out whether the size of their industry is sufficient. We'll look at their market, if they're in commodities, where that's sitting and where it's going for the next kind of 10 plus years. We'll look at all of our risk factors, basically, and try to bundle that up and see if it's something that we can put forward. Our project returns are usually based on the term that we can get for an offtake agreement with them. And we usually shoot for kind of minimum 10 years, so we're there for the long haul. We've got a 30-year asset, so 30 years would be even better, but 10 years gives them a lot of savings and removes a lot of initial risk for us. So it's a really good spot.
Hmm.
We'll also identify where their growth is into the future. So the abattoir I mentioned in Juni, for example, great case study where we managed to build exactly what they needed on the day, and they've had some great savings. Their scope 3 emissions have come down, and that was important because their biggest customer was a large grocery store here. There's two main grocery store chains here. One of them
Hmm.
was their largest customer, and they said, "What are you doing about scope 3?" And they said, "What's scope 3?" So we took it from there with them, and we've really added quite a bit of value. Now they've asked us to come back because they've grown, and they've grown quicker than what they expected. Although I'd like to think that we're a big part of that. I think we were certainly a part of it. So we'll approach it in a manner that we're looking at a 10-year minimum offering for them. We will build, own, and operate everything everything. So all the upfront work, all the modeling that we do on their demand data. So we'll take a minimum 12 months demand data and model it against various scenarios of both solar and BESS or battery. And we'll identify a number of potential designs depending on what the future looks like for them. We'll sit with them and agree what the best approach is and where the best price point is as well. So we always price from the ground up. The market prices from the hype down, so it's a different approach entirely. And then if we land on something
Exactly.
that could be 3, 6, 12 months away, we end up signing a power purchase agreement for that term. We build, own, and operate. And the first day that they start to pay any money is the day that we start supplying those kilowatts and the meter starts turning. So they don't pay anything up front. We do all that work with them, but it's part of our trust building process. At some point, their IC, their CFO is going to look at it and say, well, why don't we go to tender? And then everyone will say, well, we've already done all this work. Why do we need to? They're right here. You can press the button. And then sometimes they say, well, why don't we do it ourselves if it's so easy? And then they realize that their core business is entirely different to our core business. And if they put their time and money into that, they're going to get better returns. We can put our time and money into the other thing. It turns out to be a very mutually advantageous relationship. And it has to be for the long term because these are big assets.
Exactly. Well, I think it also comes down to the fact that this isn't just a typical infrastructure fund. You know what I mean? Like Create works kind of differently, and maybe break that down in a sense that, what makes it difficult in terms of how you think about risk and scale, because that's a completely different, ball game than, a regular developer coming up to, doing this kind of work.
Yeah. So risk is, there's a lot of areas of risk that we can go into, and it's constantly on our mind. But I always look at risk in one hand and opportunity in the other, because there's plenty of opportunities that other people won't touch for different reasons. Maybe they don't recognize it, or maybe they do and they just don't get all the risk factors around it. They haven't done it before, and sometimes you just have to stick your neck out. So we're lucky. We got some good investors who said, guys, stick your neck out. See what you can do in this space. They saw a gap and they wanted us to do our best to address it. The scale question always comes up, and it's always on our mind as well, too. I think what you'll find is that generally speaking, there are 3 areas in this industry. One is a residential and commercial. So that's rooftop panels. You don't need a development application from local government to get those approved. It's relatively quick, 3 months turnaround, and suddenly you're generating, and everyone feels great. And then there's large scale, where you've got 300 megawatts, in that field over there, and there's some sheep grazing under it, and that feels good as well, too. But in the middle, there's our customers who are on the grid and don't have enough room, perhaps in the backyard, to put a massive solar farm, don't have enough rooftop, or the roof wasn't built properly to withstand the kind of weight that they'd actually need for panels there. And they want to do something. They want to save money. And then second, they want to meet their ESG targets, but they don't know how. It's hard to advertise that kind of thing. We could, and it's very tempting always to look at the larger projects and say, well, let's talk about bigger ones. But when you put more eggs in that basket, you really are wholly reliant on that project going forward and then having a return, which is, I guess, sufficiently de-risked. But it's hard to do that. There's a number of markets that you can sell on, and you mentioned the merchant market when we were talking before. We could talk about that in a sec, but that's basically a spot market. You're a price taker, and we'd prefer to be long-term and boring. That's our approach. And how boring can we make this? Meaning we've de-risked it so much that we know what our returns are going to be. We know where our tolerance or our thresholds are in certain areas, and we also know that we've designed it in a manner that we can add additional value into the future. Why not put a central inverter down with 3 additional DC terminals, because you don't need a battery today, but you might need it in 3 years. We didn't think about that 3 years ago, and now we're thinking about it on every project.
Exactly.
It's a different approach. And for the scale question, just to round it off, yes, we can go larger than 5 megawatts, and we are on some of our projects, but our investment criteria has to be the same every time. That's what gets us over the line with our investors, and that's what kind of keeps, I get, that degree of continuity. Really quickly on investment criteria for us, I mentioned the 10 years before. Love it. Minimum 10-year offtake agreement or PPA. We typically do a 10, but we have up to 25 years in some of them. We look for a minimum 80% of our generation to go behind the meter. Now that could be in real time or it could be stored with a battery as well. So the flip side of that is we look for a minimum 20% exposure to the merchant market. So that's the level of risk that we're willing to balance.
That sounds great. I mean, what's something that most people misunderstand about, developing or even owning commercial solar and, BESS systems, or BESS for everybody? What's harder than it looks?
I think if you want to think about it more visually, I mentioned before that the panels on the roof for some of those residential and commercial properties, as soon as those panels go on the ground and you've got third-party ownership, that you've stepped over this chasm of complexity where
Hmm.
suddenly you require land lease, you require dual access rights, not just to the land, but to the grid. You require a development application, and depending on the size and the impact, it could be, for us, we've got three tiers of government: local, state, and federal. It could be all three tiers if it's big enough and it has enough impact on particular species on the environmental side. But
Hmm.
we try to keep always the local government side. We try to go for that 3 to 4 months turnaround time. Again, predictability, as boring as we can make it. And if it doesn't work there, then we'll move it or we'll redesign it. And there's different ways
Hmm.
to do that. But all of that will take 6 to 12 months. There's a lot of prep. Now you look at the different designs. I was looking at the extension of the Juni one I was talking about before, and we're physically looking at the footprint moving slightly just so that we don't encroach any easements or other areas which could suddenly trigger, another three
Hmm.
to 6 months of environmental studies and things like that. Why bother? Let's just make it smaller, slightly smaller, but we'll know that it goes ahead. And so we're trying to take the risk and the impact out of all of those things as much as we can, I suppose. But they're there. As soon as you go from the roof to the ground, a lot more effort goes into it. Just, I guess, probably just to round that one off, keep in mind that we're minimum 10 years, but the assets are 30-year assets. Nobody wants stranded assets. We're big believers and now practitioners of the circular economy principles. And so we look at what are we doing after 30 years? Well, certainly we're looking after 10 years of what we're doing. So we're constantly planning ahead to say, how is this going to work once this project ceases its PPA term, or if this business winds up and has to close shop? How does that work as well? Is there an opportunity there, or is it really just like let's just retain what we can to move forwards? You have to build in extra risk mitigation and getting onto the grid. So being on or near grid is important.
Hmm.
We try to do it from day one, but if it slows down a project so much that it would possibly move that project off the priority list, then we might choose to build it anyways, knowing that the
Hmm.
technology that we're using is acceptable to the network service providers, and we'll deal with that maybe during year one or year two after a bit of revenues come in, as opposed to having to do it as part of our financial investment decision process. So I've probably gone off a little bit on that one, but yeah, I like talking
Well,
about
no,
it.
I kind of want to talk about the entire market as, general, which you're kind of tapping into. I like to think that clean energy markets are learning from each other, around the globe, especially, my position. I'm able to talk to a bunch of people everywhere and kind of see how things are evolving in different places, and maybe how, one location can learn from what anyone else is doing in another. And of course, policy and governments and, all of that is obviously a limitation. But, what do you think other countries, including US and Canada, the ones that, we're like this podcast is mainly and now obviously expanding into Australia. But what do you think these companies can learn about, Australia's BTM and CS and C&I solar landscape?
Learn from us. So Australia and the culture in Australia is wonderfully laid back in some areas, but is highly regulated in others. So I've been in the wind industry first. I saw a lot of private investors from the States, from Europe and Britain and a few other places come in with all the best intentions and bags of money, to invest because they're like, oh, Australia, lots of wind, lots of sun, let's get into it. And when they got here, they got tired quickly. After 6 months, they realized that this is a very bureaucratic country. So I think some of the similarities we probably have is that there is a degree of bureaucracy in getting planning and environmental approvals, which can be improved on. They shouldn't be removed. I'm a backer of all of that, but I do think there are better ways to do it. And having worked for both EPA, like in Alberta back in 1999, and then working with them on the other side here as well too, we all recognize there's areas of improvement, but I think that's the same across the board, right? So I think there's no secret sauce over here that you guys haven't looked at, and in fact, often we look overseas to say, what are you doing? How are you doing it? I think the bottlenecks that we always run into are working with the grid. Grids traditionally have been built for centralized generation and then decentralized or distributed demand. And so, high voltage lines here, they go out in this direction and they get rid of their and then the furthest you can go is the worst quality electricity. And that's just how it works. And now we've had decentralized or distributed generation where you're like, well, suddenly we've got generation popping up everywhere and it's not the way we built the network. It's a challenge, but it's not a bad thing. It gets politicized for all the wrong reasons. We're all doing the same thing. We've all got the same challenges across the board. They look slightly different sometimes. I would say Australia, though, if I was to take it on it. I think we're still very much the lucky country on a number of levels. We've got good relationships with China. Over 90% of our equipment comes from China. They're great prices. They're great quality. There's nothing to complain about there. The competition is so hot in China that we're just benefiting from it. And it's a wonderful place to be. So if we want to decarbonize, you put aside some of those political views sometimes and you just say, well, this is how you're going to do it. Because we're not going to do it. We're trying to manufacture, but much like the States and Canada and other places, it costs a lot for us to manufacture these things. So if we want to do it, we've got to take a more global perspective, I think, on procurement and partnership as well, too. Absolutely.
Exactly.
So that's something that I think Australia probably is quietly luckier at when it comes to development is the procurement side from China.
That's very, very interesting. I don't know what I was expecting as an answer, but that's definitely something that a lot of people don't think about. I mean, that relationship is huge. And, another big thing is actually getting in front of customers. I mean, I know we talked about pre-call a little bit about this, but how are you getting in front of customers and, what does that entire deal process look like?
Yeah. It's different every time, and because we're a small company, so we're kind of 4.5 people right now. I think in the next 6 months, though, we're about to take a bigger step. So I think we're about to double in size for all the right reasons. I'm not a big advocate of grow quick and break things. I'm rather because it's not my money. Even if it
Fair
was my
enough.
money, I probably wouldn't. But the fact that people have entrusted their money in us makes me take a slower and more considered approach to these things. However, we can move so much quicker than some of the bigger companies. So actually, I might ask you to re-ask that question in a second. Before I do, though, you mentioned before about kind of competition and where others are playing. If I could just mention this, when we started this, a lot of the larger companies wouldn't look behind the meter. They wouldn't take the time to work with some of these smaller companies who are now becoming bigger. And what we've got out of it is a number of diverse geographic and sector-based portfolio of projects, and we'll continue to build that as well too. But now what we're seeing is that companies are getting smarter and they're trying to do a lot more on their own, and that's great. And they understand the industry more. They understand the opportunities that are available to them, and that's great as well because the conversation is easier. But some of the larger retailers, electricity retailers, who used to just kind of be quiet and behind the scenes, and they had the buying power from the larger generators, and so you just go to them if you're a government because it was safe. They're now coming down to the agribusiness size that we're working with directly and saying, hey, can we throw some panels and batteries behind the meter at your place? We might just use it a little bit to work on the FCAS market here. It's called the Frequency Control Ancillary Services market. We'll have a long-term relationship. It'll be great. And I was surprised when I realized that one of our main competitors are now these big retailers who are delving into that kind of mid-scale industry size. That's been a surprising change in this market, being in competition with various sizes.
That's amazing. Well, you also touched on how in the next 6 months you're looking to double in size, and maybe just to pick your brain a little bit more, what does the next 12 to 18 months look like for you and the team? Like, what's the pipeline looking like?
Yeah. So we've got a great pipeline ahead of us. The pipeline changes, you could say weekly. There's a number of projects that we're working on now, which I know won't come to fruition for whatever reasons, because they're not wholly in our control. We work with a lot of other parties. We have to do as much as we can to ensure that we've secured a good opportunity to work with them for the long term, but not so much that we're wasting time. And so we have to be selective about who we work with and make sure that the counterparty has a level of credibility that we know is investable and that we really do have a realistic opportunity to work with them in the future. So to date, and probably to touch on the question before, which I didn't answer, sorry, was that our network of contacts that we've got in Australia, from wind development in the past to solar development now, has been the only way that we've kind of marketed. We've come across and said, "Hey, have you heard about this? Can we talk about this?" And pre-COVID, we were really looking for projects, really trying to build that pipeline. But it's funny how if you can withstand a number of challenges in the market and you're still standing, people look around and go, "Yes, that's right. I've heard of you." And there is a degree of trust. So if you can come to them calmly and say, "We've been here the last 5 to 7 years. We've put 4 projects in the ground. We've got a pipeline for another 4 to 5 over the next 18 months," then they realize that you are real and not fly by night. And that's one of the biggest concerns. If you don't have the trust of these counterparties, you've got no hope of moving forward with them. So that's what we've focused on, is building out our network. And then to your question now, our pipeline has probably slimmed down in the number of counterparties that we are looking at, but those opportunities have increased. So we've gone from a single site, single project, to a virtual power plant kind of model, where in one state they might have 10 or 12 sites. 2 of them might be really big loads, like quarries or something like that. And they're the perfect spot to put additional solar and BESS facilities there. But we'll size them such that the demand supply across all of their 8 to 12 sites can be met to whatever that peak number is for peak value. So that's kind of where we're moving into now, the VPP area, because the level of complexity is higher, but the outcome is still the same. They get renewable power. It is absolutely measurable, accountable, and they get it for a better price than what they're getting elsewhere. And that's the thing something, probably the main takeaway message that I try to ensure that every one of our potential counterparties is, we're not going to do this unless you're getting a better deal than what you're on right now. It sometimes takes a moment, but when they look at it, they say, okay, so 30% of our very large input cost, being electricity, 30% I can hedge for the next 10 years. That's the way they end up thinking about it, saying, all right, well, everything else is variable, but if I can lock in that price, and we'll CPI index that one, so everyone's protected, but they'll know exactly what they're paying. Year 3, year 8, year 15, they'll know exactly what their cents per kilowatt payment is going to be with us, and they're comfortable with that.
That's fantastic. I think that's a fantastic way to kind of end things off, because honestly, Shane, this has been one of the most detailed and practical conversations, I want to say, we've had about what it really takes to scale clean energy, especially in like a distributed world. So I want to thank you so much for joining us. And where can people learn more about your projects or connect with you and the
Feel
team?
free to jump on the website. My phone number and email are on the website, so I'm happy to chat with anybody who wants to chat.
That's fantastic. So everyone, you guys can visit climatecapital.com.au. All of their active projects and info about Create is there. And, like Shane said, they're always happy to connect. So thanks again, Shane. And that's everything for today's episode. So if you're an energy operator, infrastructure investor, or someone thinking about solar strategy, at a bit of a larger scale, send this episode to your team, because the future of clean energy isn't just happening on the grid. It's happening behind it. So subscribe to Off the Grid on the Record on Spotify, YouTube, or whatever you get your podcasts. And until next time, stay smart, stay strategic, and stay off the grid.